So the idea that the dollar losing purchasing power is evidence of its failure, I think, is to misunderstand the design of the system. That's a feature of fiat currency. It's all part of the same system, is that a US debt crisis is a global debt crisis. There is no such thing as a US debt crisis that the rest of the world gets to avoid.
Hey everyone, welcome back to another episode of the Tullux podcast. I am super excited for today's episode. I am joined by Brent Johnson, the CEO of Santiago Capital. For any of you guys that have been active on social media in the finance space, you might know him as the Dollar Milkshake guy. I say that very endearingly. I think it's a really interesting theory, and it's what Brent has somewhat been known for. So, Brent, you've been gracious enough to give us some of your time today and tell us a little bit, talk to us about the US dollar. It's something that's so misconstrued or misunderstood. So I appreciate you taking the time to join us.
Well, first of all, thanks for having me. I've been looking forward to talking to you, and hopefully I can answer some of your questions and provide a little value to you and your audience. I am kind of known as the dollar guy, which I think is kind of funny in some ways. I really came up with the whole dollar milkshake theory as a way to explain to my clients what I thought was going to happen in the years ahead. And I've always worked with individuals and families. My clients have typically not been other institutions or other money managers. And so I've always had to try to figure out ways to take sometimes complex ideas or subjects and kind of boil them down into a way that I thought my clients would be able to understand, because many of them are very intelligent, very smart, but they're just not finance professionals, and perhaps they don't understand all the lingo or the different programs, and don't necessarily like reading monetary policy. And so the milkshake theory was really a way for me to explain. And I started this back in 2018, 2019. And essentially what it said was that I thought after 40 years of interest rates going lower, all the debts in the world had gotten to a size where I thought they were going to start going higher. And because of all the debts in the world, that would cause a number of problems. I also thought because interest rates would start going higher, that would pull capital into the United States and into the dollar, and it would make the dollar stronger versus its fiat peers. But I also thought that it would cause U.S. equities to go higher, because I thought as those flows from around the world came into the U.S., it would push prices higher. And I thought gold would go higher as well, because even though that flows are coming into the dollar and the dollar may be rising versus foreign currencies, it can still be getting debased over time. And I thought that would start to play out in a bigger way. And we didn't get the crisis that I thought we would have. We got close a few times, but we didn't get the crisis. So from an event perspective, the theory turned out to be wrong. But from an asset performance perspective, it turned out to be right. And so that framework has really helped me understand, and my clients understand, what's happening, why it's happening, the associated volatility that's gone with it over the last 5 or 6 years, 7 years now, and where we think it's headed from here. So it was that sucking up of capital from around the world was my way of saying the US dollar and the United States was going to drink the rest of the world's milkshake. And so that was the genesis of that idea.
It's going to suck up their liquidity.
Yeah, that's exactly right.
So like really quick, when people talk about the dollar, like I hear all the time when I'm talking with kind of the general public, people say like, oh, the dollar's crashing, and what they're sort of meaning is like from the inflation angle, right? Like, hey, it's the dollars in my pocket are buying less groceries at the grocery store today. The dollar's crashing, right? Or look at the value of the dollar over the last 150 years, it's totally crashed. It's worthless. It's worth 99, 1 cent on the dollar originally. And they're thinking about that, like that hard back, the greenback in their pocket and what it can buy for them in the grocery store today, right? Or at the gas pump or whatever. What is a dollar more, when we say in this conversation, the dollar, what does that really refer to?
Yeah. So, well, it honestly, it refers to both. And let me tell you what I mean. But specifically, when I talk about a strong dollar associated with the dollar milkshake theory, I meant relative to other fiat currencies in the world. And this is specifically why I say those who say the dollar is going to crash, the US dollar is going to lose its global reserve currency status, the rest of the world is going to reject the dollar and start using something else. That is completely wrong. And I've tried my best over the years to explain why that is wrong. The simple answer is because it's a relative game. There is no, despite all the problems that the United States has, and there is many, and we could spend this entire show talking about all the problems the United States has. But the reality is all of these other countries have the same problems that we do, and they don't have near the advantages that the United States has. And as a result, on a relative basis, the dollar, in my opinion, is going to dramatically outperform the rest of these fiat currencies. Now, having said that, you're absolutely right. But I should say, many people in the financial media, when they talk about the dollar dying, they will often talk then about purchasing power, right? And that is a real thing. And that is, but that is not a bug. That is not a bug that will lead to the dollar dying. That's a feature of fiat currency. If governments wanted currency to hold its value, they would just use gold, or they would use some kind of a hard money, or they would not have a policy of it constantly expanding the monetary supply. But they don't want that. And so the idea that the dollar losing purchasing power is evidence of its failure, I think, is to misunderstand the design of the system. Furthermore, I think it's very important for people to not just sit in cash for that very reason. Debasement of fiat currency is a real thing. Debasement of the dollar is a real thing. All you got to do is look back through history and talk to your grandparents when they'll tell you that candy bars cost a nickel or whatever it was, right? And now they're a couple bucks. So the loss of purchasing power of the dollar is a real thing. However, what I will say is that the dollar rising versus foreign currencies on the global stage, that will end up causing a crisis, and that has caused several crises over the years. And in those crises, asset prices tend to fall and deflation overtakes inflation. That happened in 2020, happened in 2008, happened in 2000, et cetera, et cetera, et cetera. So the point I've tried to make is, yes, you should absolutely have an investment portfolio that sits in real assets and sits in stocks and has exposure to financial gain, as opposed to just sitting in fiat currency that loses value. This whole debasement trade will not take place in a straight line, because as the dollar gets stronger versus foreign currencies, it will create the conditions under which these terrifying drawdowns, such as 2020, 2008, et cetera, come along. And in those drawdowns, if you're leveraged, or if you don't have some money on the sideline, or you don't have some kind of hedges against your asset portfolio, you can experience that severe drawdown, and perhaps you end up being a distressed seller. And so my point has been, you need to understand the way the system works. You need to understand that the dollar rising versus foreign currencies is actually a very important thing, and that is what will cause a crisis along the way.
Why the dollar? What drives your theory at a deeper level? Like, why would people want to get into the dollar? I mean, the U.S. government continues to just print money. Congress can't stop spending. So why would people want dollars?
Well, so there's two things. Sort of depends on which people you're talking about. And I'll explain what I mean. If you're talking about Americans have to use dollars, right? That is the currency under which we are required to pay our taxes. It's the currency under which you have to pay your mortgage. If you don't like the dollar and you think you should not have to use it, I would encourage you to go down to your banker and ask if you can pay your mortgage next month in euros, right? Or in gold or in oil. They're going to look at you like you're crazy. So Americans have to have dollars. Now, so then the question becomes, why would the rest of the world use dollars? Well, there's a couple reasons there too. Number one, even though the dollar may be bad, in almost all cases, it's better than their local fiat currencies. So if our dollar loses 5% versus inflation this year, and their currency loses 15%, they would be 10% better off by sitting in dollars than sitting in their local currency. So again, it's a relative game. But the other more important thing, and this is what I think most people don't know this, even people who have worked on Wall Street for a number of years don't typically understand this fully, is that there's two markets for the dollar. There's a market inside the United States for the dollar, And then there's a market outside the United States for the dollar. That's called the Eurodollar market. It's not euros. It's not the euro currency. It's just a definition for a dollar or dollar credit that's been extended outside the United States. And that balance sits outside the United States. And that market is much bigger for the dollars that sit inside the United States. So another popular figure that we will often hear is that the United States owes 40 trillion, right? Which is an incredible amount of money. And it's certainly a problem. And it's certainly something that we should be concerned about. But what often is not mentioned is that the rest of the world owes over $40 trillion. It's denominated in dollars, and they owe it to each other. They don't owe it to the United States. And so if you owe somebody something in dollars, that creates demand for dollars because you have to get the dollars to pay that off. In the same way that you have to pay, your mortgage in dollars because your mortgage is denominated in dollars. If a Turkish shoemaker borrows money from France and it's denominated in dollars and that loan payment comes due, that Turkish business has to source dollars in the Eurodollar market to make that payment. That creates demand. If that demand is not met, then you will get a default. And if a default happens, that creates a credit contraction. And in the credit contraction, money disappears. And that when money disappears, it makes the few money that remains go up in value. So it's because, and that Eurodollar market is enormous. It's been around for a number of decades. It wasn't forced on anybody. They willingly did it themselves. And that is the money that is used to operate on the global stage. If oil trading takes place between Australia and Japan, it's done in oil, it's done in dollars. If Japan buys soybeans from Brazil, it's done in dollars. If France trades with South Africa and they buy copper from a South African copper mine, it's done in dollars. And so the dollar is an extremely important currency, whether we like it or not. And it's I kind of joke around, but water, for many people, water is kind of like or dollar is kind of like water to a fish. Most people don't even think about it. It's just there. Just because you don't think about it doesn't mean it's not important. And in fact, it's one of the most important things. And that dollar liquidity, that global dollar liquidity, if it ever starts to disappear, that's what causes a financial crisis, whether it's the Asian currency crisis, whether it's the Chinese renminbi real estate crisis, whether it's the 2008 global financial crisis, whether it's COVID. All of that stuff is related to dollar funding.
Why would all these countries choose to use the dollar? Like, if I'm the Turkish shoemaker in your example, and I'm trying to borrow money from a businessman in France, why would I not borrow money in the Turkish lira or oh my gosh, France is on the euros.
Yeah.
Okay. So why not euros? Why not lira?
There's a couple of reasons. Number one, they could, but often if you borrow in lira, there's not much demand for lira. Outside Turkey, there's not much demand for lira. So if you're going to borrow lira, you're going to pay a higher rate. So you can often, there may be some other contingencies applied to it as well. And it's just not, and the Turkish lira market's just not as big as the Eurodollar market. So, and there might not be as many players willing to extend that funding to you in lira. So they could, but sometimes they won't. The other reason is because of the growth of this Eurodollar market means that buyers and sellers, borrowers and lenders, what they're trying to largely do is match up the liabilities on their balance sheet with the assets on their balance sheet, so there's not a currency mismatch. In other words, if you have a company and you have to pay your workers every month in dollars, it makes sense to keep your reserves in dollars, because if you had to pay them in gold and the gold price went up, then you would have to spend more to go buy that gold to pay your workers. So if you hold your assets and your liabilities in the same currency, you remove that arbitrage risk. And this is where it kind of helps to understand history, because history is what led to the growth, the fantastic growth of this Eurodollar market. It kind of goes back to the 1970s Well, actually, I could make this very long, but I'll try to make it quick. Post World War II, the United States was designated as the global reserve currency, and it was backed by gold. And then all the other currencies pegged to the dollar. In the early 1970s, for various reasons, the United States removed that peg to gold. And then all of these currencies were just free floating for the first time in a very long time. And that created a lot of uncertainty. And that could have spelled the death of the dollar that many people now speak of. What happened relatively shortly after losing the peg to gold was that the United States entered into an agreement with Saudi Arabia where they would price all of their oil in dollars. And so when the rest of the world now needed to buy energy, and the OPEC then followed very shortly thereafter. And so if anybody on the global stage wanted to buy oil, and everybody needed oil or energy to run their economies, whether you were in Asia, Europe, Africa, South America. And so everybody needed dollars to buy the oil. And so they started denominating they started borrowing in dollars. They started holding reserves in dollars. They started invoicing in dollars because energy was the most important input. And then over the subsequent 3, 4, 5 decades, that market just kept growing and growing and growing and growing to where now all of that market is largely credit. It's money that's loans that have been extended, credit that's been extended. And so now they're trying to match their assets with all of those huge liabilities that's been extended. And so when somebody makes a loan, on the one side, they're borrowing that money. But on the bank side, they're extending that money, and that's an asset. And so they want their asset to match to their liabilities. And since this is the biggest, deepest, most liquid market, they typically do it in dollars. And so and it's kind of like a network. Part of the reason people use it is because people use it. It's kind of like Facebook, or it's kind of like Twitter, or it's kind of like Apple iPhone. That's the network. And you don't have to use it, but it's just easier to use it because everybody else uses it. Or you use it because there's the most efficiencies. There's the most apps that are hooked onto it. It's so it's this growth of this network and economies of scale and efficiencies that have led to the growth of the Eurodollar market. So going back, this is a very long way of going back to your question. Say they don't have to use dollars. They just often do because it's typically fastest, easiest, and cheapest. The problem, though, becomes when the dollar rises in value versus their local currency, they have that currency mismatch, and then they get into trouble.
Yeah. I think what I just heard you say was that like the euro is the green text message equivalent, and the dollar is the dollar is if you have the blue text.
That's a great analogy, actually. It's not that it doesn't work, but it just, everybody says, hey, look at this guy. He's got the green text.
Yeah. Your group messages don't work right all of a sudden, Obviously I'm kidding. So bring up the petrodollars is something interesting. We hear a lot, this speculation, like, hey, the BRICS countries, right? These oil producers, they're working on forming their own currency, and it's going to, dethrone the dollar, and the dollar is going to lose its global reserve status, and the BRICS countries are going to replace it with whatever the heck they're going to call it, the BRICS dollar. I don't know.
Yeah.
How does that? Does the dollar have a moat there? Is that a real risk? Is that what would the impacts of that be or not be?
Yeah. So the first thing is that there's a number of different countries, different organizations, different alliances that are trying to come up with a way out of this. I call it the Eurodollar trap or the Eurodollar prison. They don't like being beholden to the dollar. And so they're actively trying to come up with things, but it's much easier to say it than to actually do it. It's actually really, really hard to do it, in the same way that it would be hard to unseat Facebook or unseat Twitter or unseat Apple or whatever. It's not impossible. But it'd be very hard, and there's a lot of pain involved in doing it. So that's number one. Number two is, let's pretend that let's say the BRICS did launch a currency. And let's say that a few people started using it, and they started using that rather than the dollar network. If they do that, that means they're going to be pulling liquidity away from the dollar network And now that new liquidity would be migrating to this new system. The issue is that all of that debt that I talked about earlier, that 40 trillion plus in the Eurodollar market, it's still out there. It still needs to get serviced. It still needs to get paid off. So now you have a situation where all those liabilities are still there, but now you have fewer currency units and less liquidity needed to service it. And in that environment, the dollar probably rises. And as the dollar rises, it puts more pressure on the rest of the world. And you get one of these currency crises or a credit crisis or a credit contraction, and it slows growth. And this is part of the reason why anytime you've seen a country try to leave the system or has some kind of a debt problem, it's because they're having trouble getting liquidity to service these US dollar liabilities that they already have. If there was a way, and here's the issue is, if those loans do get defaulted on, again, they're not defaulting on the United States, they're defaulting on other entities outside the United States. The solution would be if the whole world could agree that we are no longer going to use the dollar and we are going to use some other currency. And we all agree that we're all going to transition from using the Eurodollar to this new currency on the exact same day, at the exact same time, at the exact same terms, and everybody agrees and nobody pushes back, then theoretically it could work. But anybody who's ever been in a meeting with more than 3 or 4 people knows getting everybody to agree on something, even what kind of lunch you're going to have that day, is not always easy. So rewiring an entire global economy and getting everybody to agree so that not one link in the chain breaks down, because if one link breaks down, the whole chain breaks down. It's just, again, it's much easier to say it than to actually pull it off. And the other thing is, if that did happen, and there's been occasions where this has been happening, the United States will undoubtedly say, that's fine, but then you're no longer going to trade with the United States. And the United States is most countries' biggest customer. So I don't know about your business, but if I lost my biggest customer, that would hurt. If I lost my second biggest customer, that would hurt. And most businesses out there, if they lose their first or second biggest customer, it's going to hurt. Now, is that necessarily fatal? No. But I also don't know many companies that are happy to lose their first or second biggest customer. And the third thing is that if that didn't even work, my guess is that the United States would then try to enforce it using the US military, right? And it doesn't always come to that, but sometimes it does. And I don't necessarily like that. That's not necessarily the way I would choose to run the world, but I think that's the way the world is. And so the idea of moving away from the dollar, it's not that it's impossible and it's not that it couldn't happen. I've come to the conclusion that it can't happen without things getting very volatile along the way. And in that volatility, I think the price of the dollar rises versus foreign currencies.
Yeah, I think what's interesting that you just said to me is, the U.S. is a lot of these countries, biggest customer in terms of trade, right? Obviously, we have this big, consumer-driven economy in the U.S., and we like our cheap stuff, right? It's actually, would you say that it's beneficial for these other countries to have a strong dollar so that we can, buy more of their stuff at a low price and have, that bleeds through? If we're able to, the dollar's strong, we can import the stuff that we're buying at a cheaper cost, and it actually helps offset inflation within the United States. But do I have that? Do I understand that right?
I think that's right to a certain extent. And I just wrote a very long paper a month or so ago, and I titled it The Band. And I titled it The Band because as long as the dollar stays within this range, the whole system works. And to your point, a strong dollar and a weaker local currency for these, it helps them. It allows them to sell their goods into that stronger dollar environment. And the fact that their currency is weaker makes their goods cheaper, and it keeps the system working. The problem is if you get outside of that band, problems start to happen. And the real problems happen when you get out to the top side of that band. There's a show called Landman with Billy Bob Thornton, who's the main character. And in this show, he's an oil guy in West Texas. And he explained, in one of the scenes, he explains to one of his coworkers why the price of oil needs to stay between, I think he said 85 and 65 or something like that. He said, if you know, if it stays within that band, you're making the companies are making enough money that they can keep pumping the oil, pay their workers, develop more wells. And it's also not so high that the consumer gets tapped out and has to spend all their money to put gas in their gas tank. But if it goes above that band, now all of a sudden consumers have to spend all their money putting gas in their tanks, and they can no longer go out to eat, go to a movie, buy a new washing machine, et cetera, et cetera. So that causes problems. If you go below the band, then the oil companies can't make money. Production shuts down. They have to lay people off. And then when demand comes up again, the supply is not there. And then you go back into the band. And I think that's a very good analogy for the dollar. Again, if the dollar gets too strong, it causes these debt crises that I'm talking about. If it gets too weak, then what happens is those local currencies are now getting stronger. It makes their goods more expensive. It makes it harder for Americans to buy them. Americans buy less, and then those countries' revenues go down, and then they can't meet their debt. So, again, if it stays within this band, it works for everybody. But if it gets outside to either the upside or the downside, bad things start to happen.
How does the interest rate cycle affect this? All else being equal, like I don't love the idea of buying, German bonds, but if German bond, if the currency was relatively stable and I could get 15%, but it was 5% yields in the U.S., like, well, maybe I might want the German bonds. So how does that dynamic play through into the whole?
Well, so it's a great question, and it plays into it a lot, and I'll explain why. So number one, if their currency was stable, then you would absolutely prefer to receive that higher interest rate, right? But that's the question. Is the currency going to be stable? And if it's not, and you make 15% on the coupon, but you lose 20% versus the dollar, you've actually lost, right? So now you have to be pretty sure that the currency is going to be stable. That's number one. But number two is if interest rates go higher in the United States, and let's just use right now. I mean, the 30 years over 5%, right? That's the highest it's been in like 20 years. And so if you can get 20% to own a US Treasury, which the whole world needs and the whole world uses because of this Eurodollar market that we've already talked about, and by buying a 10-year Treasury, you have now matched your liabilities with your assets, so you don't have that currency mismatch. The rest of the world is going to have to pay even more, or corporates around the world are going to have to pay a lot more in order to attract that marginal dollar to them to then take that corporate risk and that currency risk. And so by interest rates going up in the United States, it actually also causes rates to go up around the world, or it causes foreign corporations to have to borrow at a higher rate. Now, perhaps there's one or two companies out there somewhere that have sterling balance sheets and an amazing product and have, never missed a dividend payment in 100 years of history. And maybe those companies will be able to issue closer to the 10-year rate than others. But by and large, corporate bonds all over the world are priced off of the 10-year U.S. Treasury rate. So if the 10-year U.S. Treasury rate goes higher, global funding rates are going higher as well. And so it's not that that higher rates wouldn't be a problem for the United States. It absolutely would be. But it's not a problem for the United States in isolation, while the rest of the world doesn't have to worry about it. And this is one of the points I've tried to make, is that a U.S. debt crisis is a global debt crisis. There is no such thing as a U.S. debt crisis that the rest of the world gets to avoid. It's all part of the same system. That is not the case when you reverse it. A Turkish debt crisis does not have to be a U.S. debt crisis. A French debt crisis does not have to be a U.S. debt crisis. Australia, Thailand, China, it doesn't have to be. It can be, but it doesn't have to be. But the reverse is not true. If there is a U.S. debt crisis, the whole world is going to have a debt crisis.
I think, yeah, what's the old saying, right? When Wall Street catches or when Wall Street sneezes, the rest of the world catches a cold.
That's exactly right. And then again, it's just the way the system is designed. It's not fair. It's just the way it is.
Well, life's not fair.
Right.
Um, I want to expand this to equities and international investments in portfolios. When I was in the graduate portfolio management class, they would teach and they would say, hey, every portfolio in the US should have some element of international, equity exposure, because there's a lower correlation to US stocks. And so it can dampen the volatility and increase the, expected return over the long run. In practicality, I'm a little bit more of a tail risk guy. And so I look at it and say, okay, well, if in a good year, I'm getting less volatility because I'm getting some non-correlation. But when there's a US debt crisis, the rest of the world absolutely has a debt crisis. So I'm not actually getting the diversification when I theoretically want it the absolute most, right? What's the value of it long term then? How would you square those two different, angles, thinking through the lens of the dollar milkshake theory?
Yeah. So again, you have good questions. So this is very important, and this kind of goes to the heart of the way I have designed portfolios for my clients, and that is the diversification of which you speak is absolutely true when things are good and everything is fine. The problem is in those terrifying drawdowns that I talked about earlier. I talked earlier that I thought equities were going to go up. I still think they're going higher in the years ahead. But I think just like there's been these terrifying drawdowns over the last 5 or 6 years, they're going to continue to have those terrifying drawdowns. And I think when those happen, the rest of the world will have those drawdowns as well, and potentially even to a greater extent. And I don't think they will recover as quickly as the US. So if we were not in a situation where the debts had gotten so big, and if we were not in a situation where the Eurodollar market had not grown so much, and we were not in a situation where the world was no longer cooperating and was no longer moving towards globalization, but was rather now fighting with each other actively, both in trade and military. And I feel like we're moving towards deglobalization rather than globalization. I think the likelihood of things going well and things being good over the whole world has decreased, and the likelihood of these, shocks or volatility episodes or crises, however you want to describe it, I think the likelihood of those happening is higher. And as a result, I think the periods of time where things are good will perhaps not be as prevalent as they were kind of 10, 20, 30 years ago when those ideas were first professed. And I think because of this milkshake theory and the drawing of liquidity into the United States, I think it's very unlikely that the rest of the world dramatically outperforms the United States. So let me just give you an example. Let's pretend that the S&P 500 goes up 13% this year. And if that happens and emerging markets go up 17%, I don't know if that 4% extra is enough to warrant the additional downside that I see in the emerging markets. And part of the reason, though, and this should be explained, is like, who are my clients? I think you kind of really have to understand what are you trying to achieve and who are you trying to achieve it for? Most of my clients did not come to me to get rich. Most of them did that on their own, and they have come to me to keep them that way. And that's kind of a joke, but it's kind of the truth as well, right? They have already, amassed a great deal of wealth. While they would certainly like to beat the S&P 500, that's not their primary goal. They don't really need to beat the S&P 500 to maintain their lifestyle. And for those who are kind of moving towards retirement or newly into retirement, their portfolio rising 25% next year probably is not going to change their lifestyle a whole lot. But if they go down 25% a year, because we're trying to beat the S&P 500, and as such, we have to own, all equities, that could dramatically affect their life, and that could dramatically affect their retirement. So we gear portfolios more towards protecting their lifestyle, getting a fair return, outpacing inflation, as opposed to trying to beat the S&P 500. So in a year like I just described, where if I can get double-digit returns or even high single-digit returns by a diversified portfolio that takes some of this, huge downside risk off the table, and emerging markets make 15% and outperform me by 3, 4, 5%, I'm fine with that. I don't need to chase that extra few percent in order to maximize returns, when I think chasing that same extra 3, 4, 5% could lead to a massive drawdown.
I think that's, correct me if I'm wrong, but that's really just a long way to say the equity risk premium, the market risk premium in emerging markets really isn't big enough relative to what it should be, with the understanding of the currency risk you're taking on by being invested there.
100%. You got it. That's a much quicker and easier way to say it than I said it.
I just want to make sure. Well, I think you had a really good context that explained it, but I just want to make sure, like, okay, when I pass that back through, am I capturing that right?
Right.
I think if we would have just said the market risk premium is not great enough in, in emerging markets, probably, a nerd like myself might catch that. But I think the viewers probably of the episode really appreciate your excellent explanation, which I think was just excellently put. I think it is an interesting thing to build portfolios, and this idea of, the world benchmarks, the S&P 500. One of the things that I've found peculiar about the S&P 500 in the international equities conversation is just how much of the actual earnings within the S&P 500 are derived from international business, right? I think it's somewhere along the lines of 40 or 45% of all the earnings, right? So if we say of all the companies, if they did $100 in, earnings, like, well, $40 to $45 of it came from their business activities in Africa and Europe and Asia and all these places. And so at a certain point, they're getting those other foreign currencies, right? In their, you sell an iPhone in Europe, you're going to get paid in euros for it. And then Apple converts that euro back to dollars. And so if, to a certain extent, if you get this period where there is a weak dollar, right, you get that currency boost, right, from that international activity in a certain extent. And I think that's where, would you say that's what drives when people say, hey, a weak dollar is great for, equities?
Yeah, I think that's part of it. And I think your point is a very good one. And that, I should have said that. That's another reason why I don't think it's necessary to go buy these international or developed market equities, because by and large, if you own the S&P 500 or companies, large blue chip companies in the United States, you're going to have kind of by definition exposure internationally already, right? And to your point, I think they they can then either make the decision, those companies, to hold the euros on their balance sheet or convert them back to dollars. But to be honest, they are probably better at making that decision than individual investors are, right? So again, the need to go buy specifically international companies, I just don't think it's there. And especially when I think the United States will continue to get the majority of the flows in the years ahead. Now, the other thing I should say, I don't want people to think that I'm Cassandra and I think you should just ignore all these problems and buy U.S. equities and everything's going to be fine. I do think they're going to go higher in the years ahead for a number of reasons, but I don't think it's going to be smooth. I think it's going to be incredibly volatile. I don't think you should ignore the risks that exist. And I think the other thing that I always do, I always have some kind of downside protection, whether it's cash, whether it's a portfolio that I think has enough diversification that the correlations don't all go to one in some kind of a liquidity scenario, whether it's hedges, whether it's a tail risk exposure. I think everybody should consider that. One of my favorite people to listen to talk to about finance is Paul Tudor Jones. And Paul Tudor Jones is kind of this legend. I'm sure you've heard of him, but for the listeners who have not, I would encourage you to go look him up on YouTube and listen to his different speeches. And he is very famous for saying if people spent, a tenth of the amount of time on how not to lose money as they do on figuring out how to make money, they would be much better investors. And I think that's very true. I think, especially young people. I mean, the thing is, young people can actually afford to take more risk because they have more time to overcome it. But I think a lot of people, when they start looking at investments, they just focus on how are we going to make money. And I think the first question should be, let's make sure we don't, or how do we make sure we don't lose it, right? Because by the law of compounding, if you lose 10%, you need more than 10% just to get back to even. And so it doesn't take too many losses to compound before you've put yourself in a real hole. And now it's a struggle just to get back to even. And so that's a big part of our thesis as well. We believe that investing primarily in the United States. Now, I probably have a few positions here or there that are more internationally focused than the US, but by and large, my focus has been in the United States. I think it will continue to outperform. And in the occasions where the United States doesn't outperform, I don't think we will trail by a whole lot.
I think that all lines up with the initial theory that you explained around the dollar, right?
Yeah, exactly.
It's that embedded currency risk when you're investing internationally. So anyways, well, I think we're running out of time here, but I really appreciate it. This was a great conversation. I think you do such a great job at explaining these nuanced things really, in my opinion, elegantly. And so I really appreciate you taking the time to hop on today and share your thoughts about it.
Well, I appreciate the invite, and I wish you and your audience the best of luck.
Yeah. Hey, if anyone wants to find you, Brent, where's the best places to find you or follow you?
Yeah, so I'm pretty active on Twitter. If you look up Santiago AU Fund, that's my handle. Or if you just look up Santiago Capital, it's a white seashell is my logo. If you go to research.santiagocapital.com, we've got a couple different levels of research that are available for subscription. And then finally, we have a show we do on YouTube every week called Milkshakes, Markets, and Madness. So you can check us out on any of those platforms, and we'd love to interact with you.
Awesome. Well, hey, thanks again for your time. We really appreciate it.
Thank you.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.